Ladies and gentlemen, good day and welcome to the Q2 and H1FY22 earnings conference call of Gujarat Thermis Biosyn Limited. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Dr. Sachin Patel, Director at GTBL. Thank you, and over to you, sir.
Thanks very much. Good afternoon, everyone. I would like to wish you all a very warm welcome to GTBL's earnings conference call for Q2 and H1. I would like to begin by expressing my gratitude to you all for taking the time to join us today. Unfortunately, Mr. Rajneesh Anand will not be able to join us for this call as he is not keeping well. However, we have on this call with us Mr. Tushar Dalal, our Group CFO, Mr. Sangameshwar Iyer, our Company Secretary, Group Company Secretary and Compliance Officer, and Bridge IR, our Investor Relations team. Since this is our maiden earnings conference call, I would like to share a brief overview of our company and its recent developments before we get into the business and financial performance. GTBL was established in 1981 as a joint venture company between the government of Gujarat in form of GIIC and Chemosyn, and subsequently it became a listed entity in 1984. GTBL has grown over years through collaboration with various other players such as the Pharmaceutical Business Group, that is PBG, and Yuhan Corporation. In due course of this time, GTBL established a strong R&D which enabled it to develop its own expertise in fermentation products. Today, GTBL is one of the few fermentation-based manufacturers of pharma intermediates in India with a robust technical know-how and capabilities. We have an environmentally friendly and sustainable process using aerobic bacteria for fermentation. Our current product portfolio grew with rifampicin in 1991 and lovastatin in 2003. Subsequently, the company started manufacturing rifamycin S as an intermediate for rifampicin. During the year 2020, we changed our business model from contract manufacturing to own manufacturing and sale model. After fulfilling all the contractual obligations, we were able to make the strategic shift, which has led to improved realizations and substantially improved margins. This change gave us better access to markets and a competitive advantage to command better margins. Our current product portfolio comprises of Rifa S, that is rifamycin S, and rifamycin O. In addition to the state-of-art manufacturing facility in Vapi, Gujarat, we are also expanding our R&D base to focus on new product development. As mentioned earlier, fermentation-based process for intermediate development has its own challenges, but with our long experience of product development and making it commercially viable, our confidence is high. I hope you must have gone through the presentation where we have also mentioned about a roadmap for development and launch of new intermediates. Also, we plan to move up the value chain and forward integrate into manufacturing APIs. As for numbers, the impact of the change in the business model is evident in the performance over quarters since the shift, barring minor fluctuations due to lockdowns. Now coming to some key recent developments. As you're all aware, during the last year and a half, the world has witnessed an unprecedented calamity in form of the COVID pandemic, which brought the whole supply chain and the entire economies to a staggering halt. It impacted every aspect of our lives, from personal lifestyles to businesses and industry worldwide. Like every other business, we were also impacted by the logistics and supply chain hurdles due to various lockdowns to curb the virus outbreak. The second wave also led to a lockdown in the beginning of this fiscal year. However, being in the pharmaceutical sector, we were able to continue to cater to our healthcare industry. During the first quarter of 21, we undertook a planned, during the last quarter of 21, we took a planned shutdown of our plants for approximately 3 months. This was for maintenance and upgradation of the facility, which is done periodically. As a result, we were able to improve internal operations efficiencies when we resumed operations. On another note, we recently concluded our strategic partnership with South Korea-based Yuhan Corporation and bought over their stake in a company with parent companies, group companies. While Yuhan has been one of our oldest technology partners, the association had come to its fruition and there was no further value addition for either of the two companies. The decoupling would enable us to better formulate and execute future growth strategies in the long term. Going forward, we are focusing on R&D and new product development and strive to expand our presence in the value chain and overall market. Now, coming to the financial performance, I shall hand over to Mr. Tushar Dalal, who will take you through it. Thank you.
I am Tushar Dalal, Group CFO of the group. A very good afternoon to all of you. Now, let me take you directly to the Q2 for the financial year 22. We reported rupees 35 crore in the revenue during the Q2 financial year 22, a 28.86% year-on-year rise. This growth was driven by higher volumes and better product mix. Our EBITDA, excluding the other income for the quarter, was 18.45 crore, an increase of 25.1% year-on-year, and our margin was 52.60%. Our PAT during the quarter is at 13.79 crore, as against 11.35 crore in the second quarter of financial year 21, an increase of 21.5%. Net profit margin stood at 39.35%. The earning per share for this quarter is 9 rupees and 49 paise. The paid-up capital per share is only rupees 5. For the half-year end date, H1 22, we reported rupees 67.49 crore in revenue during H1 for 22, a 57.46% year-on-year rise. Growth was driven by strong rise in the volumes and the improved product mix. Our EBITDA, excluding the other income, for the period stands at 35.17 crore, increasing 64.84% year-on-year. EBITDA margin is 52.11%, an improvement of 233 basis points. For PAT, during this half year, is 26.71 crore, as against 16.92 crore in the first half of financial year 21, an increase of 57.8%. Net profit margin stood at 39%, higher by 11 basis points. The earning per share for this period is 18.39. This is all from our side. We can now take the questions. Thank you.
So should we open for Q&A?
Yes, absolutely.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi, just want to get a better understanding of, who are the key players in this market, since it's our first con call and we are just, trying to understand your company. What would be the total fermentation capacities in India and who are the key players? And, I am told that there's pharmaceutical application and non-pharmaceutical applications also for fermentation, like mock meat and so on. So want to understand the dynamics and where we stand in this, the whole picture. I'll come back for the second question once.
So I think as a company, we are purely focused on pharmaceuticals, so we would have little knowledge on the fermentation sector, which is not pharmaceutical based. As you rightly pointed out, you have sectors like food supplements, at the same time enzymes too. So I would not get into that. But from a pharmaceutical perspective, there was a time where there were almost about a dozen or even more companies in India, which unfortunately could not stay for a very long time due to the competition that came, the pricing competition that came from China. So at the moment, there is probably a handful of companies that still remain, but as an independent company, I think it would be Concall, that will be one of them, and there are one or two more which are coming up as independent fermentation-based companies.
And this China competition that the whole industry faced, a few years ago, was this driven by which of the price cost levers that they had? And I can see power cost is a significant part of your process, but outside of that, what were the other advantages that China had, and what has changed in the last 2 years for this, migration back to India?
I think there have been two factors. So one is, as you very rightly pointed out, power. In case of fermentation, the largest cost in terms of utilities comes from power. The raw material cost is not as significant as the cost of utilities, which is essentially power. So that is definitely one. And as one sees across sectors, not just fermentation, but across sectors, due to the increase in power costs or tariffs in China, and also the unavailability of the same in certain areas, there has been a disruption in supply chain. At the same time, prices also. So I don't think it is only related to fermentation, but overall you have seen increase in prices of products coming from China, and this is one of them. And I think the only difference over here being that there are not too many companies that still continue to be in fermentation of pharmaceutical products in India. So we believe that there is a unique position that all those companies who are in the fermentation sector for pharmaceuticals that are there in India have going ahead.
A little basic question out here. So what is the complexity in fermentation that a large player who either the API large player who's buying the intermediate from you, or the formulation player who is buying API is not doing the same thing in a captive manner, because our Indian pharma companies are largely champion companies who have now gained significant global market share in formulation. So what is the complexity of what is the specific reason why large companies don't prefer doing this in-house and would have players like you or Chinese players kind of handling this complex product?
But the complexity starts from the fact that you need to have access, or you need to be able to develop those microbes that are going to produce this product. That is only the beginning. The second part is these microbes behave very differently when you move them from a laboratory to a 50,000 liter fermenter. So the economics completely change. So that is the second part of complexity which is there. The third is how do you design these kind of fermentation facilities from lab data to commercial data. So that's know-how, and that knowledge is very important, which not too many people have. And fourth is, which is probably easier, I would put it this way, is the capex which is required. So you may start in the laboratory, but for example, a replacement value of a facility that we have right now would be upwards of 200 crores, excluding the land and the paraphernalia that goes with it. So that is the kind of capex that you need to put in while not knowing a lot of what is going to happen from the laboratory till you reach final production. And then there is time, because it would take at least 2 years, if not more, to set up this facility. Followed by that, it would take even more time for regulatory approvals to come in. So there is a good gestation period besides the risk which is involved in going for this.
Got it. And the last question before I get back into the queue is, want to understand, from again a macro picture, which are the therapeutic areas or products that use fermentation in the API? A significant portion of the API value is being derived out of fermentation. And so from where we stand here, I would like to understand the 5-7 year opportunity in therapeutic areas. And again, there are a lot of biologic products that are coming in from new drug discovery. Is there an opportunity in that space also in small batch production? So if you could kind of map the current fermentation landscape and how is it likely to change over the next 5-7 years?
So I'll divide the question into, I'll address the question into two parts. The first is therapeutic categories that involve fermentation. They are wide and varied because you have something which is starting from penicillin derivatives to other anti-infectives, and then you have something which is even in the field of statins, which is cholesterol reduction. So it is more depends upon what is the synthesis or how a product is produced more than therapeutic category. And our selection again is for products that we want to work on or we are working on in terms of the future is not therapy dependent, but is technology dependent. What are we going to be good at in terms of producing, we believe? So that is going to be the strategy going ahead. And with regards to biologics, that's a completely separate area. We are not into it as yet. We don't know what we will do going ahead, but at the moment, our focus is on secondary metabolite fermentation products and not biologics. I hope that answers.
Thank you. Thanks a lot. Yeah, thanks a lot. I'll get back into the question too. Very insightful.
Thank you.
Thank you. The next question is from the line of Keshav Kumar from Raxan Investor. Please go ahead.
Hi, good afternoon, sir. Thanks a lot for taking my question. Sir, since December 2019, our margin has expanded considerably, and your disclosures had attributed the change to the change of the business model, the reason for the same. But I noticed that you had also started making rifamycin O, which is used for rifaximin, around the same time. So how much of the shift or growth has come about due to Rifa O?
So the change has come in because of the change in business model and not necessarily in terms of what we are producing, whether it is Rifa O or Rifa S, because the concept essentially is that before that we were working on a cost plus basis or a fixed margin basis, and then we went out after concluding all those contractual obligations, we came out of it and we started moving to a market price based model. So that was a big change that led to change in the margins rather than one product over the other.
Sure, sir. And sir, on your website, if I can see that it's largely a 2-product company. Is that right?
That's right.
Okay. So, sir, could you elaborate if we do get a substantial chunk from Rifa O, or is it not largely contributing a lot to the overall picture?
I think it would depend from month to month. Overall, we would say that it is probably evenly balanced out.
Sure, sir. Thank you. That's all from me.
Thank you. The next question is from the line of Puneet, an individual investor. Please go ahead.
Hello, I am audible?
Yes, sir.
Yes.
Yeah. Okay. Thanks for giving me this opportunity and congrats for the wonderful results. Sir, I have 2 questions. One is on the sales and operating profit margin. So can we consider the recent run rate of 30 crores, which is very good actually in the last 2 quarters? Is it sustainable along with your operating profit margins of 50% approximately? So one, it is sustainable, and from where it is coming? Is it because of volumes or something else? That is question number 1, if you can answer first.
So, I think we would not be making any forward-looking statements in terms of what is going to happen ahead. So unfortunately, I will not be able to answer that particular question. With regards to where the margins are coming from, I think it is efficiencies and market price related pricing with better efficiency. So that is where the margins, I would say, are coming from.
Okay. So my second question would be, what is your capacity utilization as of now, and any further plans for capex in the coming quarters or months?
In the last financial year, our capacity utilization was about 75%. In the first 2 quarters, we are close to almost complete capacity utilization.
Mm-hmm.
And we have significant capex plans going ahead, considering that we want to increase the number of products that are there. We don't really feel the need to increase capacity for our current products, but we definitely see a lot of opportunity in terms of introducing new products, which we are working on in the facility.
Okay. So are they expected to be launched within this current financial year, or the plans are further ahead for those?
It would be further ahead. There is a gestation period, so it would be further ahead.
Yeah.
Definitely not in this financial year.
Okay. Yeah, that's from my side. Thanks a lot for giving me this opportunity, and wish you well for the coming quarters.
Thank you.
Thank you. The next question is from the line of Ranveer Roy, an individual investor. Please go ahead.
Yeah, hi.
I'm not able to hear you very clearly.
Hello.
Yes.
Is it better now?
Not completely.
Yes, sir, your voice is breaking up. May we request you to move to a better reception area, please?
Hello. Is it better now?
Yes, sir. Now
Am I audible?
Yes.
Yeah. So I wanted to touch upon the earlier participant's point is on the capex. So you just mentioned that the plans are significant, but the capex will start contributing from the next year, financial year. Is that correct understanding?
Yes. The return on the capex would be in the next financial year, or even the year after that, perhaps.
Okay. And these will be products in similar lines. The fermentation will be a technology to start with. The genesis
our business will be focused on fermentation products. Yeah.
Okay. And so I'm presuming, the capex, will be largely funded from the internal accruals, the reason being the kind of cash you guys are generating right now, and there is no debt on the company,
So I'm not able to hear you very clearly, unfortunately.
Hello?
Sir, your voice is very faint, sir. We are unable to hear you clearly.
Is it better now?
Yes.
Hello?
Yes, sir. Please.
Yes.
Yeah. So the capex will be largely funded from internal accruals, or how this is, or debt funding would also be required for the capex?
For the moment, it will be internal accruals, but we are open to moving to debt too, considering the fact that the project cost is anticipated to be in the vicinity of about 200 crores plus.
Okay. And this 200 crore capex which you guys are planning, this will be in the one phase, or I feel like the entire 200 crore capex will be commissioned over next financial year or a year after that?
No, it would be spread over 2 to 3 years.
Okay, got it. Thank you. That's all from me.
Thank you. The next question is from the line of Nikhil Upadhyay from Security Investment. Please go ahead.
Hi, good afternoon. Thanks for the opportunity and congratulations on good set of numbers. Continuing on the discussion, you mentioned that basically if we look at in last 1 year, the way government has moved around on the fermentation facility where India is weak and the PLI schemes which are coming up, are you looking at participating in any of the PLI products, or is it purely new products which you are developing?
No, our strategy is not focused around PLI products. Unfortunately, products don't match what we are looking at. So our products are pretty much out of that box.
And can you just share what is the pipeline of product in terms of number of molecules? Would it be like 5, 7 molecules which are currently in the R&D stage and would be scaled up?
We're looking at 6 products for now.
Products, and these would be like their commissioning would be in line with the CapEx commission.
Absolutely.
And a large part, what we understand is from discussion with various players is like China was a key player in the fermentation facility globally and even in India. These 6 products, would it be largely like import substitution kind of a market which we are looking at? And even on export in the fermentation-based products, has there been significant prices have gone up significantly where you see that are entering those molecules may make sense now versus earlier?
I think so. The strategy that we are going by has to be a mix of replacement of imports plus new products which have literally just come out. So we can't work on a strategy which is simply replacement of China. I don't think it could be something that would be great. So it is a mix of both, and our product selection and how we intend to commercialize the same is also very clear in our plan. Obviously, this is something which would be, I think, trade secrets at this stage.
Sure. My question could be a little bit, but what we understand is like the reason why most companies, as you mentioned, is like the capex is a major deterrent in terms of any new player entering the fermentation manufacturing. As a result, there are many very limited capacities in India or players who are able to do it in a successful way. How do you see the scenario playing out? Because what has happened is that the pricing has also gone up for many of these molecules with the issues around China. Incrementally, there could be more players. So is it capital the only reasons for not putting capacity, or is it like the ability to handle the molecules in a successful way a larger barrier?
So I think in the 4 points that I raised, I in fact raised capital as only the 4th point, which I said was insignificant because you will always be able to find capital. So I don't think that is a deterrent if project has viability. I think it is more of the know-how and people. These are the 2 key points I believe in this industry going ahead. Capital will come from one source or the other, in my opinion.
And lastly, you mentioned like 3 years back there was a change in the contractual terms from cost plus model. So can you just educate me what was the earlier arrangement and whom we had the arrangement with, and what was the reason for the change in model? So is it like we decided to end the contract, the customer is the same, but on a new price basis we have entered the contract? Because I'm new to the company, so I don't know what was the history of earlier and now what has changed.
So we had a contract which was a cost plus based contract where we had zero risk in terms of the cost to be covered, and we had a fixed margin business over there. And from there, we decided that we were working with a single company, and we decided that we would like to come out of that, take the risks which would come with moving into with a market price model rather than a cost plus model, which means that if we were not able to sell, we would have a problem. But we decided to come out of that contract and enter into a sales contract, which was market price dependent.
And this contract was not related with our parent company, Thermis Medical. It was an independent company, is it? Or?
Yes, it is. It was an independent company. It was nothing related to the parent.
fine. I'll come back in a bit. Thanks.
Okay, thank you.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead. Mr. Desai, your line is in talk mode. Kindly go ahead with your question, please. As there is no response from the current participant, we move to the next question from the line of Vaibhav Barjatia from HNI Investment. Please go ahead.
Yeah, hi. So thanks for providing the opportunity. Just have one or two questions. So on the existing contracts that we have with the customers, if you can help us understand, what is the general typical nature of the duration of the contract, and how the price resetting mechanism works. I mean, is it resettled every 1 year, 2 years, 3 years, or what is the general tenure of the contract?
So I would only say that they're fairly stable contracts. Anything beyond that would be difficult for us to put out in the public domain.
Yeah, I think, okay, I understand. I think that's it from my side. Thank you. Yeah.
Thank you. The next question is from the line of Karthikeyan from Shreyas Advisors. Please go ahead.
Yeah, good afternoon, sir. More of the same set of questions. So just trying to understand the business a bit better. My first interaction, so kindly bear with me. A couple of things. You talked about developing 6 different products. So can you talk about the process involved in developing new products? And is any of this coming from a customer's request, or do you develop these independently? Secondly, also the capacity you are planning to put up. Can you give us a scale perspective in terms of what percentage of, say, a local requirement would this be able to meet, or global requirement? I wouldn't have a context. So kindly, talk about that. And also, is there any dependence on China for the basic material sourcing, the microbes, the basic cell cultures or whatever? Would those be coming from China? These are the 3 broad questions that I have. Thank you.
So I think in terms of, I'll address your second question first. In terms of the capacities, the total fermentation capacity we have at the moment is about 450 cubic meters, and we are planning to double this, for which we have already received the EC clearance. So that's on the capacity side. With regards to raw materials or anything else associated with this project, we are not depending upon China. And could you repeat your first question again? Was it with regards to the product?
I was asking you about the product development cycle involved and whether there is any customer input involved in the process.
Yeah. So the products are developed in-house, which means that we are not expecting nor are depending upon any customer to provide us any help on this particular front. In terms of the cycle, it typically involves having the strain, growing it in a laboratory, growing it at a pilot facility, understanding the strain, how it grows, what is the most productive, most efficient way of producing it, and then scaling it up to a commercial level. So it's a step-by-step process. At each stage, you understand what are the environmental conditions which are best suited for a microbe to grow and produce what you want it to produce. And that's how the process works. And finally, when you move to a large scale, you have to figure out how you are going to be able to extract the product of interest from this broth, which has a lot of things, including the microbe, to its pure form that is required as a pharmaceutical product.
I broad contours, I understand. What I asked you was, what was the time involved in developing these 6 different products? And, so if you start today, by when would you be able to commercialize a particular product?
So we envisage that in about 2 years, we'll start producing them for the Indian and the ROW markets, and
okay.
3 years for the regulated markets.
in 3 years you will be able to target the regulated markets.
Yes.
Oh, interesting. And when you say that there is no China dependence, so these are locally available basic materials as such.
Yes.
Okay. Interesting. And would you be able to indicate the areas, broad areas at least, to say therapeutic or otherwise?
No, unfortunately not, because it would give a very clear idea in terms of what molecules we would be perhaps working on.
And in terms of yield, would you be able to confirm whether you are at a reasonably commercially, shall we say, viable yield? Have you been able to achieve that? Would you be able to say anything on that?
Yes, that we can, because we cannot compare it with other companies because we don't know what necessarily their yield is, but we can compare it with the market price.
Right. And you think that you are in a good place?
We are in a good place, yes.
Sure. Interesting. I'll get back in the queue. Thank you so much for answering that.
Thank you.
Thank you. The next question is from the line of Pratik Podar, an individual investor. Please go ahead.
Yeah, hi. Sir, just a bit curious, when I look at your balance sheet, the CWIP 4 crores, you talked about a 200 crore capex. I'm just trying to understand, where do you get this confidence of, even if I look at your net fixed assets, they're just like 17 crores, and you're setting up a 200 crores kind of a capex. Where is this confidence coming from, and when does this capex really start contributing to your revenues? Is it H2 of FY23 or FY24? That's question number one.
So I think we, in terms of confidence, we see an opportunity, and we see cash flows, and both these things combined together, we feel that, and we have the knowledge. I think probably the third part was the most important, the knowledge and the know-how to be able to do that. So that, I think, gives us a reasonable confidence that we should go ahead with these projects. And with regards to when the project will come through, it could be end of 23, beginning of 24. But I would say 2 years from now, we should be in a position to have something for the Indian or ROW market, Indian and or ROW market.
Sure. And sir, what is the size of opportunity of these 6 molecules? Not getting into the names, etc. Just broadly, what kind of potential are there for these molecules?
So the way we are calculating it is that if we are doing a capex of 200 crores, we should be able to see a ROI within 3 to 4 years.
Okay. That's really helpful. And lastly, sir, is it fair to say that you are a company since 1981? Was this contract of contract manufacturing something which was a shackle to you, and once you got out of that contract, that now we will see the true potential, or you can see the true potential of your R&D getting commercialized? Was this
I wouldn't say that. I think the contract that we had before was also a very important one, because those were turbulent times in this industry. This opportunity that we see at this time did not exist at that time. So I think it's a question of standing in the right place at the right time.
And when you talk about, circling back to the ROI question, when you talk about 3 to 4 years ROI, is it post-tax, pre-tax?
That'll be pre-tax.
Okay. And lastly, sir, any specific reason that, we're such an old company, we got listed in 84 as we talked about, yet we're not scaled up. So any thoughts as to why has that happened?
No, I think, so as I said at the start of the first question that came in, the fermentation industry in India went through turbulent times. So there were lots of ups and downs. And if you see all the major companies had fermentation units, but at some point or the other, they decided to stop them. And the reason essentially was that the companies were bleeding because of the pricing pressures which were there, which has changed now, not from only a pricing pressure angle, but globally companies are also looking at building up supply chains which are varied. So I think both those things combined together make it an interesting area to be in.
Got it. And sir, are these margins which you have reported sustainable? Last question.
I think what you're asking me is to speculate what the pricing of the product from elsewhere in the world is going to be going tomorrow.
Okay.
It's hard for me to say that.
Fair. Thank you. Thanks.
Thank you. The next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, you're able to hear me?
Yes.
Yeah. Hi, Sachin. Good afternoon. Sachin, the first question is, so you talked about the process or the difficulty level in the fermentation side, where when you scale up to commercial scale, how the living organisms behave on a much larger reactor. It's very difficult to predict. So when you go into the capex mode, I'm sure that the risk will exist where you scale up from lab scale to the commercial scale. So how do we handle that risk apart from having the prior experience? How do we handle that risk?
I think that is what you said is the key thing, prior experience. That is probably the most important aspect in terms of designing facilities in terms of new products that you want to set up. So, for example, this current facility was also set up, or the key modifications were made with the technical collaboration that we had with the Johan Corporation at the time. And through that experience of working together for so many years, we have learned how to do the same. So that is where the crux lies in, we believe.
Okay. But is it a possibility that for a different molecule, when you actually go for scale up, it may take much longer than anticipated, and we may have to kind of realign the process or the parameters, and the stabilization timeline can be different than what we anticipated in the beginning? Is that one of the...
Absolutely. No, it is absolutely possible. The entire exercise from day one till even after 15 years of production is a reiterative one whereby we have to keep on improving the thing. So it is a continuous process. Improvement is a continuous process in this area, like most areas, I think.
Okay. Second question, Sachin, is I think you mentioned, if my understanding is correct, that the replacement capex required for what the setup that we have today is, can be close to 200 crore. Now, does it mean that for the incremental capex that we are going to put up, the typical asset turns would be somewhere between 0.7, 0.8? Is that a right way to look at it?
Sorry, I could not follow your question.
So currently we are doing, like let's say full capacity, we will do 140 crore of revenue in our existing setup. And if somebody else was to put up this setup, it may cost him 200 crores. So is that the right asset to revenue ratio for the incremental capex?
So I think someone asked a question with regards to what is the revenue that we would expect from the new capex that we are putting up, and I responded that this is the ROI we expect, because revenue is, I think, not as material as the margins that we are going to make over here, because it depends upon what we produce. Sometimes in this particular case, for typical API industry to have this margins, you would have to have significantly larger revenues than what we are seeing right now. I trust you will agree with that. So I wouldn't go by revenue. I would more go by the bottom line.
Okay, got it. And last question. So I think you said that we have 6 products, which we can commercialize over time with the new capex. But in terms of the overall product basket or the team that you look at, how many products you start with, and then finally at the commercialization stage, you may end up with 4 or 5 products. So that ratio for number of products that you work on with how many products gets commercialized, That is like what, 3:1, 4:1? How does it work?
I think it's a good question. One cannot expect that everything that one works on will actually reach the market. But I think we would have to work on a dozen products to get 6 out. That's for sure.
Okay. Or it can be more also. Or, I mean, because typically,
yes,
2:1, 3:1 is a very normal ratio.
No, you're right. It could be more, but right now this is what.
Okay.
Okay. With time, we will figure out what more is required.
Okay, great. Thanks a lot, sir.
Thank you. The next question is from the line of Alisha Mahawala from Envision Capital. Please go ahead.
Hi, sir. Good afternoon, and thank you for taking my question. So firstly, I'd just like to understand that, like you mentioned earlier in the call, the capex that we're currently talking about will sort of commercialize only towards the end of 23, 24, and our current capacity is also utilized. So in the interim, over the next 1 year, where is the growth going to come from? Is there scope to debottleneck or change our process or product mix or anything on those lines?
We are working on multiple strategies in terms of what we could do over the next couple of years, but not absolutely clear on it. But it's a work in progress.
Okay. So for the timing, I think the current run rate is sort of what we will be able to achieve till something commercializes. Got it. Okay.
That's right.
And the tuberculosis drug that we do, what is the contribution of that to our overall revenue?
So it's pretty much the same as I think this was a question which was also asked, how much is Repower, how much is Refire. So it's pretty much in line with each other. There is no one which is bigger than the other. Depends from month to month.
Sorry, I didn't get that.
I said it's pretty much the same. Both of them are pretty much the same. The two products that we have are pretty much the same. There's not a large difference between the two.
No, I understand. I'm just trying to say, but putting those two together, how much would that contribute to the total revenue?
100%. These are the two products.
Okay, that is 100%, right? There is nothing else.
Yes.
That's just what I want to clarify. Okay, great. Okay, thank you.
Yeah.
Thank you. The next question is from the line of Srinath V from Bellwether Capital. Please go ahead.
Hi. So just wanted a few clarifications. So the capex that we are putting, again, very basic question. Does it come in a phased manner, or we'll have to get all the reactors together at one go? So this 200 plus crore capex, how would this play out from capacity addition that we could utilize to generate revenues?
So it would be in a phased manner, most definitely. It will not be a single order that we'll be placing. It starts. This capex includes upgradation of certain parts of our facility. It also includes setting up a new R&D facility, a CGMP pilot facility. So there are multiple steps involved in this particular process. It will not happen on one day, for sure.
Okay, and so how would the cash outflows kind of play out? I'm looking at both from ability to generate revenues and the expenses that hit us. So how would this kind of play out broadly over 2 years?
So about 30% of this, about 30 to 40% of it would be in the first year, and the rest of it would be in year 2.
Okay. So first year would be largely more civil and the construction part of it, and the second year, the heavier part is because the machineries are purchased, right?
That's right.
The second question I would like to understand is, how much of your product segment, the spot prices? I do understand that historically we've done a lot of contract manufacturing. At that point of time, the spot price is immaterial to us, but more from understanding.
Sorry, I missed you over there.
Mr. Srinath? Seems like we lost the connection for the current participant. Yeah. We move to the next question from the line of Vaibhav Barjatia from HNI Investment. Please go ahead.
Yeah, thanks for providing the follow-up. Just as one question to kind of, if you can answer that. See, we have done this business model change from December 2019. So what was the trigger to change the model? Because why it was not done earlier and why it was not done later? What was the trigger point here which has allowed us to change this whole model?
Our contract was getting concluded at the time, and we saw market opportunity whereby we felt that it is worthwhile taking the risk of getting into business ourselves.
Got it. And secondly, this Chinese competition, so why they are not able to compete now? See, I'm not talking about what has happened post-COVID. There are supply chain disruptions and China plus one strategy currently going on. But our margins has improved even pre-COVID for December 19 and March 20 as well, which is pretty much pre-COVID. So our pricing was quite attractive even at pre-COVID level. So it seems like we had the pricing power and power even pre-COVID period. So what has changed from the Chinese side in pre-COVID era, which has allowed us to have such a good pricing?
The prices of fermentation products and of even non-fermentation products have increased from China, not just during the COVID time, but even before that.
Yeah, so I wanted to understand why it has increased. Why there was a price increase from Chinese players? Was it some additional taxes levied by the government, or some kind of power subsidy going away for them? What has caused them to increase the prices?
I wouldn't be able to say for sure what exactly the reasons were. I think probably most people wouldn't be able to say for sure exactly what the reasons are, whether it is power subsidies removed, whether it is export incentives removed, whether the financial costs have changed, whether environmental regulations have come in, or whether it is an amalgamation of all these things. But the fact remains that for a lot of products, not all, prices have gone up.
Okay. And lastly, can you help us understand, or if you can name few of the Chinese players for both of our products? I think that would be really helpful for us.
I will not be able to tell you at the top of my head. I don't think there's anyone from China who's offering RIFA O. With regards to RIFA S, there would be, but it's not something that I would know, but we can. But it would be easily available from the public domain information, I'm sure.
Okay, that's it from my side. Thank you.
Thank you. The next question is from the line of Ranveer Roy, an individual investor. Please go ahead.
Yeah, I have only one question. How is the revenue split across clients? Like, what is the client concentration? Probably the top 10 clients would contribute how much percentage of revenue?
I'm sorry, what was the question? How many clients?
Yeah, so like total, how many clients do you service to, or probably like top 10 clients probably contribute how much to the revenue?
We are working on contractual basis with 2 clients at the moment, and we are adding another 2.
Okay, so it's largely the revenue coming from 2 clients, correct?
That's right.
Okay, thank you.
Thank you. The next question is from the line of Nikhil Upadhyay from Security Investment. Please go ahead.
Hi, thanks for the opportunity again. My question was, sir, when you are doing this 200 crores of capex and considering the market environment which we are seeing in terms of fermentation-based products, do you so like most other companies who are the leaders in their product segment or are undertaking a large capex generally have a good sense of the demand from the customers, or customers are generally giving a surety on the volume. So do you have any sense on or like do you have any confirmation with the client and basis which you are undertaking such a large capex, or is it like the market development would be done more post the capex? Just to understand how we are going about it.
We have a fair understanding in terms of what the market sizes are and who is doing what in that respective product in the in the world, and also a strategy in terms of how we are going to commercialize the products that we have selected. I think beyond that, it would be difficult for me to comment on.
Okay. Secondly, my question could be a bit naive, but in many chemical processes, what we understand is the chemistry, which is the chemistry and the ability to improve the yield, which creates a big difference. But then when we are going into the fermentation, you mentioned that the ability to work with the enzyme and checking on how it operates in our lab environment while in a manufacturing environment becomes the key differentiator. So, but in similar lines, like many companies work on a similar chemistry, like either chlorination, or that kind of a chemistry to improve the process and improve the yield. So in fermentation also, are there similar lines around which you would focus on in terms of enzymatic technology, or is it like it could be across multiple domains? And our current fermentation capacities, are they restricted to a product, or they can be used across products?
So, first of all, what we are doing is very different from enzymatic chemistry. That is a completely different area from what we are talking about. Enzymatic chemistry facilitates reaction A to reaction B while we are producing something with the microorganisms. So yeah. It's a different area, right? I think
where I'm coming from is like a similar line of enzymes we would be more comfortable working with, or is it like we are not restricted, we can work with multiple line of enzymes? Is there some commonality around the working process or on the R&D process? Just to understand, this could be very basic question. So,
yeah, so it is. We are in a position to handle multiple strains or various strains, which is of bacteria or fungi. It is not necessary that it is only one particular kind that we need to work with.
And are the capacities restricted to a particular product, or they can be used across products? Like many in chemical companies, people do a campaign production and then use the capacity for some other product. So fermentation, how does it work?
So it cannot necessarily be used for all products, but it can be used for a few products. You have to be selective because each product has its own requirements in terms of size of fermenters and also the downstream part, which is essentially purifying the material from this microbial broth, which is there to a final API. So it is not generally possible to use the same plant for all kinds of products, but for a few kind of products, sure.
Okay, and lastly, based on our current gross block and the new capex which we would be doing, how many fermenters we would be putting in terms of number of machines? And so you mentioned that we would be doubling the capacity, almost 900 cubic meter, but that would be like across how many fermenters would you say, or how should we think over here?
I think you can only talk about volume. You cannot talk about how many fermenters because it depends product by. Some product may require a fermenter with 10 cubic meters. Some products may require a fermenter which is 100 cubic meters. So we can only talk in terms of overall volumes and not number of fermenters.
Fine. Thanks a lot.
Thank you. The next question is from the line of Keshav Kumar from Raxan Investor. Please go ahead.
Sir, for Rifa O and S both, do we have domestic competitors?
For Rifa O, no, we don't. For Rifa S, no, not really. We don't have any domestic competitors.
Okay, and are we choosing our molecules with the same strategy that we have limited competition domestically?
There are such few manufacturers of fermentation products domestically that most of the products you would select in fermentation would not have too much competition, more than one or two players. Let's put it that way.
Sure, sir. So just trying to draw the demand and supply scenario. So you mentioned that we have 2 customers currently. So is there substantially more domestic demand for the same molecules? I believe for REFA there won't be. For REFA O, or more growth will largely come for us in the future from the new molecules only?
We plan for growth from new molecules. The reason being that we would like to make sure that the risk is divided over a few products, not just 1 or 2 or 3, but many more and multiple customers. But we don't want to become we don't want to go to a scale in any of the products where we are saying that we are going to have this much % market share. We have been very clear in terms of what is the market share we would like to target, so that it enables us to get our pricing what we want with a forward integration strategy with a respective customer, if even though not identified.
Sure, sir. Sure. That's all from me. Thank you.
Thank you. The next question is from the line of Vaibhav Barjatia from HNI Investment. Please go ahead.
Just reflecting on your earlier remarks. So I think earlier you said that you currently have 2 customers and you're adding 2 more, right? Am I correct?
Yes.
Yeah. So we don't have any more additional capacity for next 2 years. So how these new customers are going to get served? Is it like there will be reduction in offtake by existing customers and the 2 new will replace them, or how it is going to work? Because we don't have additional capacity as of now.
I wouldn't say that, right? Because we mentioned that the capacity utilization in the last financial year was 75%.
Mm-hmm.
We have 25% capacity.
And we can actually go up to 100%, or I think will it be feasible to do that?
We hope so. If not 100%, at least close to that.
Mm-hmm.
There have been sizable improvements which have been made in the plant during the shutdown, whereby our productivity has improved.
Mm-hmm. Okay. Okay, that was the only clarification I wanted. Thank you. That's it.
Thank you. The next question is from the line of Jaiveer Shekhawat from Ambit Capital. Please go ahead.
Right. Thanks for taking my question. My first question is in relation to the split between the YOY volume growth and the realization growth. Can you highlight that?
Sorry, could you repeat that, please? The YOY?
Can you please break down the revenue growth? So how much is it coming from volume and how much is because of higher prices?
The pricing has pretty much remained the same. There hasn't been a very big difference over last year and this year. But as you can imagine, in the last year, the first quarter was disturbed for everyone, right?
Yes. And second question was actually in relation to the prices itself. Now, given that we have seen RM inflation over the last 3-4 quarters across commodities and across sectors, I understand that the RM cost doesn't form a big chunk of your overall revenue. But have you been able to pass on these? And I mean, are you able to pass on these historically as well to your end customers? And how much time does it take to actually pass it on?
No, we haven't been able to pass it on, and our contracts are such that we would not be in a position to pass on the RM costs to the end buyers.
And
that
finally,
is something that we'll have to absorb.
And finally, if I can understand your key raw materials, given that most of your suppliers would now be passing on the higher prices to you guys, could you help me understand what are the deals? And probably because of that, are you also expecting a contraction in gross margins going forward as well?
We don't expect a major contraction in gross margins, maybe a couple of % here and there. A lot of our raw materials in fermentation are natural products, unlike in chemical synthesis. So those natural products have not increased by that percentage. But yes, we do consume solvents for recovery, and there is a increase in rates that we see. But as I said, the impact of that would be a few % here and there.
Sure. Thanks a lot for answering my questions. All the best.
Thank you. As there are no further questions, I would now like to hand the conference over to Dr. Sachin Patel for closing comments. Over to you, sir.
So thank you very much for organizing this, and we look forward to meeting everyone during the next call. Thanks again.
Thank you. Ladies and gentlemen, on behalf of GTBL, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.